Environmental Trading Edge LLC and its members are not broker-dealers or financial advisors. All these webinars are for educational purposes only. All of our indicators and such are for personal use, non-commercial use, and are not to be construed as a solicitation of any products to buy or sell. They are not recommendations, and always talk to a financial advisor for any kind of financial advice. Past performance is not indicative of future results. You can always pause the video if you're looking at the recording right here, or review it on your own time. All right, hello everyone. Welcome to the Adapt Advanced weekly meeting. This is our first one, so on March 6th of 2023. It's good to see all you guys, and we had our one of our first adjustments today, so we'll talk about that. Some things that I'll work on to make sure that it's a little bit clearer on how those strikes were adjusted, so we'll get to that. But first, before we get through anything, let's just kind of crush through just a general overview of kind of what's going on, where the trade is at, and where the market is at as well. All right, so first things first, let's just kind of just go through in general, where's the market, where are our plans that we were already originally looking at, and just kind of what has happened over the last few days. So zooming out, here you can see that we had this general downtrend that eventually got broke to the upside that we established way back last year, just kind of really zooming out here, right? Started this big downtrend on a big macro level. And we started this kind of uptrend, this minor uptrend. We've had some of these minor uptrends last year as well. But the thing to note is that this uptrend broke through this upper resistance right here, kind of came up. We have some targets that are way up here that were set back on this really big one back here, so that we haven't gotten up to yet. And then that also coincides with a huge volume range. Like this is a very wide volume range up here. Zooming into something that's more relevant to us right now, when we first started out this trade, we were coming down here, and I'm going to set that to auto. So we were coming down here off of these highs. We didn't quite make it up to the supply line, right? Demand line got tested down here. We started this trade literally like on the demand line. So when you're right there, even though we were macro bearish, right? I think it was a heavy bearish at the time. It's now bearish. We'll talk about the changes in the metric in just a second. But basically, what ended up happening was this bounce took us up, and that's very normal, a very expected move to come off of this bottom end, right? Now, the true test will come into, is it going to be a macro-driven move, which is going to push us back down, and we're going to continue this trend to the downside, such as what green, our original track A is. So that's the track that we're actually on right now. Now you can see that we took off a little bit early, but basically the whole premise was to get up here into this 4070 level, 4080 level, which we tagged intraday today, and then basically a cool off as we roll back down through this trend. Now I'm moving this channel as this develops, right? So just know that this is kind of a fluid channel right now, because we don't quite have two supply lines to tag. And when we don't have two supply lines to tag right here, there's not much you can do except for run the supply line off of the demand line. And that's kind of not fair. That's what we originally were doing, which was kind of right here. But it's not very accurate at all. Normally, you really do want to get where the supply line is on both sides to get onto the downside. So here we go. As we're sitting right here, we kind of came up to this volume spot, came down here. The main bulk of this volume area really is actually up above like 4,100. So if you're looking at my trade, which we'll talk about in just a second here, why I've got very like, I'm very stretched out to the upside. And even though we've got a macro bear, all that kind of stuff, and it's because the potentiality is to make it back up here into this 4120, 4130 level, and possibly even test all the way to the highs, which is what red was, right? Now, in order to make it up to red, we really would have had to gain a little bit more energy down here in this volume, get a little bit more of that back and forth, and then have a blast up. that would have launched us pretty easily up there. The fact that we just had this light chop and then a blast up, it kind of sucked a lot of the wind out of the sails already and kind of used up the energy. So it's a little bit more likely we're still going to be on track A. And so that's why we're still basically developed for track A. Of course, if you look at those rules, which we'll talk about in just a second, basically, if we hang out up here for a little while, we actually will switch into a transition. So that's where we're at as far as our charting goes, as far as where things goes. We're pretty much right on track for what we basically anticipated the market, a bounce. And then how aggressive that bounce would be, like I said, first choice was A, up here into this range, roll back over, and then hopefully come back down here and test these 38.93 level or something like that, 3900 level or something like that. That would be very reasonable. And that'd be pushing into these targets as well. So 38.71, something like that. And then we'd have a little bit of a bounce, maybe a little bit of bounce or a stall for here, but then most likely we're going to come down and finish off whatever this trend is to the downside and start pushing lower. Okie doke. But remember, as this develops, as this kind of, if we start to develop up here a little bit longer, this whole channel will actually transition. So you can see how I'm kind of moving this. This whole transition, or this channel will transition higher. And then, this will kind of adjust out just a little bit. And you can see that downswing is going to be a lot slower now, right? And so it starts to make sense that we would test somewhere around these target lines if this rolls over relatively. If it gets a little bit higher and then rolls over, that would make sense. Or it transitions longer and then crashes, that would make sense as well. So that's just my general thoughts on the market right now. In general, just to kind of look around what like risk assets are doing, right? So the NASDAQ is kind of our like super risk asset. So if you look at not NDQ, but the NDX here, I am just now picking up TradingView because so many of you guys requested it, and then I also got requested from Michelle as well. Hey, use TradingView. So I'm working on it, but I'm not completely familiar with everything around there. So, anyways, nice strong bounce up off the bottoms on the NDX. The only thing is that it really hasn't created that really strong uptrend like what we saw in the SPX. Right. So when you start seeing that kind of weakness or that lack of risk on behavior, it's not as strong. But over this recent time, it's actually not as weak as the SPX. So if we get over to the SPX, you can see that the SPX is actually pulled down a little bit more aggressively. Then we can kind of compare that with our other risk on, which is say the Russell index. And from there, it actually says I've already got it on here. On here somewhere, I'm sure. It said I did. Nope. But is it because yep. There it is. All right. So on the Russell, you can actually see that today it had a really aggressive day while the other assets actually pushed a little bit higher today. So that's starting to kind of tell us that we've got a little bit of a risk off behavior. Of course, if we were to draw a channel across here, you can see that is, of course, kind of showing up in general that this is kind of all transpiring into this downtrend. So we'll see where that goes. Either way, bounce up higher, kind of a retag of these support levels, and then a bounce off of that. That's relatively normal. If this comes down and fails right here, it'll be probably a rather aggressive move to the downside. Either way, our trade won't have a problem. So let's go look at what the trade itself looks like right now. So here's about 12 where I executed things. And you can see that basically we're coming down into basically a very, very flat trade. Lots of range down here. I mean, we don't even take our typical 2 or 3% risk until 38.19. Looking on the chart on that, looking on the chart, 38.19 is way down here near these lows, right? So we've got really, if this thing broke through, came down all the way to the bottom, we would know that it wouldn't even be an issue. So that's kind of why we set that up to the downside, because we were in a stretch environment. We had just recently switched out of a stretch down to a stretch. So of course that's why I'm a little bit more, neutral-esque. Plus also I know that we were down there at the bottom of that testing range, just like we drew everything out, and we were in the middle of a volume channel. So we knew that we were going to be a little sticky in there, right? So that's why we originally designed the trade the way that we did it. And then basically, in essence, the whole trade plan, the whole premise is that a bounce up here into these 40, 80s, 40, 70 range, this thing would hold together pretty strong because we're using out of the money calls and a broken wing. So we're using a credit spread or a debit spread right here and a call in order to hedge off a very aggressive move to the upside. That's actually exactly what we got, was a really aggressive move to the upside and a bounce up here. And then just kind of going day by day on this, right? Nothing to do this next day. We just kind of had it develop a little bit, right? Nothing crazy, up 1%. Everything's really flat. This was kind of the first up move that we had off of that channel. Still nothing to do, still very flat trade, still very early in maturity. Here's another really big move. You can start seeing that you're getting this value back here in the backside of this. So that's that release of volatility as the market's kind of going up and the volatility starting to drop out. And you can see that that's that second very aggressive day that we had. I actually was talking to Michelle this morning because I would have loved to adjust this thing intraday today. And if I didn't have you guys following this trade specifically, I would have, because the whole premise was to get up to that 75 range and then tilt it and give a little bit more negative delta into it, like what I did today. But I wasn't able to go as aggressive because the market sold off in the last half of the day and didn't give us as good of an opportunity, but we still triggered the kind of general move that we were looking for. So it just means that we couldn't get as much delta on because we just couldn't contain the risk as well. All right, so what we basically did here was we chopped off the top side of this call and we brought him back. So in essence, Michelle was talking to me earlier and she kind of saw it a different way than I did, which I thought was kind of cool actually. So she saw it as selling off the call and buying a debit spread, which is true. That's one way to do it. Of course, the way that I did it, the way that I executed it, was I did a debit spread to move this call back, right? And then I sold a call to flatten everything out, right? And so what that does, if we just kind of look at that general adjustment, you can see that when I pull this debit spread back, it does increase the capital, so you got to make sure you have that margin. But when I pull this thing back, it keeps us very, very flat delta. Versus if I sell this call off first, you can see that I get really delta risky to make that adjustment, right? Because the call is just gone. I've got nothing hedging anything up to the upside. So in general, if I've got an adjustment, I want to leave my general structure on as much as possible and just move it back. And you can see here, now I've got no directional risk intraday, right? I don't want to take that type of execution risk because I want to work the market, right? And, I want to kind of see if I can get a better execution. So anyway, so there's that rollback that you do right there. So you just initially do this rollback and then you come up here to the top side and you just sell that one call, flatten it out, and boom, you're back to normal, right? And so that keeps everything really nice and flat. We got a little bit of extra negative delta on here. Like I said, way up here in the day, we would have been able to get a little bit more of a pop back here. We would have actually seen, I think, 13 or 14% at our peak, which was really nice. And we would have still kept the same amount, like about 3% risk up here at 180. So that's kind of what I'm ballparking is that 180 area. That's where I'm focusing. That's the center point of that upper volatility range up here. Is that 180? Oh no, it's the top end of that volatility range or that volume range. 180. The center point's 4140. So if you kind of look up here, hey, if we blast off all the way up here to 4140, we've got 2% risk right now, right? Now, granted, we're up 2%, but that would be a 4% total move, but only about down 2% at that point. At that stage, getting all the way up there, we're definitely going to have to, need to move this structure more to the upside, possibly even get into a structure that can handle the ranges up there, because that's a pretty powerful move off of the bottom, and it's most likely going to take a little bit longer for it to roll over. So right now we're playing a more of what this market has done recently when it rolls over. So when it rolls over, It has a couple up days, kind of a bounce, and then it rolls over the rest of the way. You can see that kind of pattern, right? Roll over, bounce, drop, go further, bounce, drop like a brick, right? So we're looking for a flash drop. If that flash drop doesn't happen, then we know that we're more likely to have something like that, where it comes down, bounces up strong, and then chops around, right? And so we'll play that kind of a move with a structure that's up a little bit up here higher in that range, with something that's going to be where we're going to get our time decay up here, and that the market's going to necessarily roll over. So we'd play something more like on track. The red track is basically what I'm talking about, which is actually, we were supposed to draw it and then get up there, but it's fine. We'll move into something like that. And so let me pull up the original plans and kind of walk through those and look what the metric looks like right now, now that we know where the trade is. All right, so the current metric right here, we've got our DTE window. So if we're starting a trade as of right now, so if you guys aren't following me and you guys are running your own, you'd be down there in this 21.35 window, which is actually about where we are right now. We're 39 right now, so we're kind of pushing that as far as my trade is concerned. Our base structures here, you can still use all the butterflies, but the calendars actually have now popped up. So that's kind of a nice little added bonus if you're a calendar type of trader and you like more calendars. That's always a good little step. As far as our gamma style, you can see that we've got basic stretch, right? So that means that there's energy both directions right now. It's really kind of, where is it going to go? We have no idea. It's just kind of back and forth. And so that's why you can see that I'm playing it a little bit more of like a mean reversion type style, where after a couple bounce days, we'll put on some negative delta. If the market starts to really fall apart again, you'll see that I'll probably soften out our delta, or the trade itself will naturally soften out its own delta. I won't necessarily trend it to the downside unless it starts to make some sort of technical break, like the bottom side of that channel breaks or something like that. And charts wise, that's where you go. Adjustment structures, you can see that a couple of our structures fell off, mainly credit spreads. So we can't do credit spreads right now, but you can still do debits, and you can do calls and stuff like that to get yourself stretched out. Something to keep in mind here, though, is that even though you can't do a credit spread, you can still use one of the base structures to offset things. So if you need a little bit of theta ATM, or maybe in front of the market or something like that, rather than breaking your butterfly with a credit spread like has been taught before, rather than breaking it with a credit spread or something like that, you can actually just put another butterfly up there or something like that. Now, of course, bringing your butterfly to a full set, like where it's an even butterfly, if it was already broken, I signify that as just adding more butterflies in, so that's allowed as well. But just keep in mind that a single credit spread is not allowed right now on either side. The macro environment switched from a heavy bear to a bearish. That's just because we got a little bit of positive movements on the GDP side of things, and some of the exports came in a little bit stronger, things like that. So it pushed us up from a heavy bearish to a bearish. That doesn't mean that it's not about to, blow up in our face or something like that, but there's this kind of tug and pull going on macroeconomically. So there's the Fed that's tightening, right? And so they're doing this whole tightening cycle, but yet the government has accelerated their spending with some of their bills that they've passed. Plus, inflation is sticking around a little bit stronger and longer. And so what ends up going on with inflation, bullish for assets. So that's a good thing for stocks as far as high inflation and high inflation staying longer, as long as the Fed isn't actively, aggressively sucking money out of the market too aggressively, or accelerating their aggression. And right now they're slowing it down. So when you get a slowing down effect of the Fed tightening and a kind of a sticky / re-accelerating inflation, like what we saw month over month, it starts to push the metric a little bit more towards the bullish side. It's not 100%. Clearly, we're still bearish, but it's there. Our general market behavior, this is something that I want to kind of pull, that is one of what I'll look at just a little bit more. Pullbacks are drawn out and they last greater than 20 days, right? We have not quite seen, a month-long pullback yet. So something to keep in mind there is that, in general, there is more downside potentiality still. And so what I would say is if we go to like a stretch up situation, that's when I'd be a little bit more concerned of the upside, and I wouldn't necessarily have the negative delta that we have on right now. I'd start flattening this back out and starting to deal with the upside a little bit more. And that's basically in the trade plan as well, to deal with the upside, right?